Welcome. I'm Catherine Magana here with Vince Stefano and Steve Wolf, where we're here to provide you some insights on the markets, investing, and planning. So first of all, welcome back, Vince Stefano. He just got back from his vacation, and with that, he brought back some market volatility. My goodness. We were in positive territory for a while, and then all of a sudden, in this last week, we've really had a run in the market. And so it's interesting, as I'm kind of reflecting back from last week's podcast and looking at how much the markets have moved. But, it's not uncommon for the markets to have some corrections. And obviously we're here to walk you through that. But we definitely had a handful of calls this week from clients. And, our job is to make sure we're educating you and making sure we're in the right allocation along the way. And, it's one of these things that, it's not uncommon to see markets move.
Yeah, I was going to say, not only is it not uncommon, it's normal.
Yeah.
Every year, just about every year, you're going to have a 10, 15% correction, sometimes a 20% correction, and that could be in a bull market. It just happens. Interestingly, that I like to look at the CNN fear and greed scale here, and we have gone into extreme fear. It's now at 22 from a 0 to 100. We were at 80 maybe a month ago. Actually, we were close to 90 at the top here, and we're now at about, and then went to neutral in the 40, 50 range. Then it went to fear, and now we're at extreme fear. All right. Generally speaking, extreme fear is where you're going to find a lot of good opportunities to buy things. That doesn't mean that can't last for a long time. It can. Other interesting thing that happened was I have a stock advisory service called Value Line that I use. And when I went to look up one of the stocks, there was this little notice on there. This was on Monday, August 5th, which was right after the weekend when the markets were down by the Dow was down by 1,000 points, which, by the way, was only 2.5%. 1,000 points sounds like a lot, but 1,000 isn't what it used to be.
But especially when you see the headlines and every news and everything.
Right. Everyone's going crazy. Yes. But anyway, so they put this little notice out there. It says, domestic economic data and market developments overseas have led to heightened investor concerns and prompted notable sell-offs in most global markets over the past few days. Although we advise that investors examine individual holdings and their own asset allocation strategy in order to best position for ongoing volatility, experience indicates that overreaction may prevent participation in a potential market recovery. And I can't say how much I agree with that, because every single time in the past that the market has gone down and we all thought it was the end of the world, it's always come back, and it's always gone back higher. Now, is that a guarantee that it's always going to do that? I can't say that. Maybe someday in the future that won't happen, but I like those odds.
I always like when the market sells off real hard. I mean, real hard, because it's a lot of buying opportunities. But again, good to be back at the table. Yep. Good to be back. I'm
surprised you still remember how to speak English. You've been gone for so long.
Well, I was thinking about the market a couple times while I was hiking in the Dolomites, but I was looking at maybe 5 points. I've got 5 or 6 points, real quick points. The last 2 to 3 months was kind of interesting. Every time we had an interest rate cut, or speaking of an interest rate cut, the stock market rallied like crazy. Now they're talking about interest rate cuts, and it's a negative for stocks. So the narrative has flipped. That's number one. Number two, are interest rates signaling a recession? I don't know, but it is putting a bit of a growth scare in the market right now, and it's causing, as you said, accelerated volatility. Number three, I've noticed that second quarter earnings have come in mixed, especially for technology stocks. A couple months ago, if things were in line, those were good results. Now, if it's in line, stocks are getting absolutely crushed.
Well, we talked a little bit last week about when is good news, bad news, et cetera.
The fourth, macro hedge funds are having a big effect on the market. You hear a lot about the carry trade, where they borrow against undervalued currencies, use that money to buy stocks. Well, once that carry trade goes against macro hedge funds, what do? They sell off their stocks in a heartbeat. And a lot of them were invested in a lot of the big AI technology stocks, and that's why you saw those stocks getting hit pretty hard.
And for those people who don't know what the carry trade is, you want to talk about that just for a minute?
Well, I just want to say that what happens is they go out and they look for undervalued currencies. And what they do is they buy and leverage against those currencies. So they use that money to go in and buy baskets of domestic stocks or international stocks.
So, for instance, when Japan is lending money at 0%,
right,
and you go out and you buy other things, that's the carry trade.
Yeah, and what happens is once that currency goes against you and you start losing massive amounts of money because you're leveraged probably 20 to 1 or 25 to 1, you've got to sell whatever you can to offset that losing trade.
Right. And I think the reason that happened was because Japan's version of the Federal Reserve said it might be time to start raising rates.
Absolutely. And number 5, the market right now, there's a lot of uncertainty with the presidential election and what's going on with heightened tensions in the Middle East. And so you're seeing a lot of volatility for there. And the last thing I want to say to my clients and anybody who's listening, do not play politics with your portfolio. Stay invested in high quality, dominant, rapidly growing companies with superior products or services to an expanding marketplace. That's what you want to own right now.
In the stock market.
In the stock market.
Right.
So looking at the Fed, obviously we've talked about in the past, but it looks like potentially there could be a Fed cut of 50 basis points in the next one, which would be in September. And then some indicators that should be coming up next week is the inflation reading, which right now inflation's at about 3%. So it'd just be interesting to see, if there are going to be the rate cuts. We talked about it all year long. It does look like that's being priced in. I've been looking at some of the short-term kind of fixed income and some other bonds, and those are starting to be priced in on some of the yields that we're seeing. So I think that, we're kind of gearing up for some rate cuts coming up.
Well, people were saying they're really panicking. I mean, they were saying we should have an emergency 50 basis point cut immediately. And I'm thinking this is just hysteria. I think the Fed is going to do what they said they're going to do. They're still data dependent. I sincerely doubt a 50 basis point cut in September. We are not showing the economic signs are not showing recession. Just not yet. Maybe they will do that, but I think they're going to say a quarter point in September, maybe another quarter point the next. They will cut, but I don't think it's going to be massive. Having said that, with interest rates probably being cut, some of the hard assets like real estate probably should do fairly well in that environment. You get, and we talked about this again the last time out, was that I'm seeing a lot more houses for sale right now. I think there's a pent-up demand, if you will, for the supply to grow. Okay, people want to sell their houses when they think they can sell it, or people want to buy new houses when they think the interest rates are a little bit more affordable. We peaked out at somewhere in the area of 7.5% on mortgage rates, and we're currently around that 6.25%. And I did find some under 6%, so in that 5 3/4 range. So people are starting to think, okay, if I do sell my house and buy another one, it's still fairly affordable, and that's a big deal for the average consumer.
Yeah, I agree.
So kind of going back to what we've experienced this last week, we have had a handful of clients that we've talked to that are really nervous about the markets and just want to make sure they're doing the right thing. And part of it is, and that's our job, is to educate and re-educate. And we have these calls and conversations, and even before you invest, to make sure we're in a good allocation. And so for us, your retirement shouldn't depend on a short term, on one day or a week. It really is a long-term view, and making sure that we're positioned well and sticking with your plan. And once again, there might be some buying opportunities along the way or some minor changes, but to completely get in and out of the market is, we think it's foolish in that you can't time that. You can't time when to get in, when to get out. And we think that potentially sometimes it's just that reaction, like I want to do something, and the reality is sometimes not doing anything is, makes just as much sense.
Well, I have this chart from First Trust that shows all of the reasons or all of the things that have happened since 2008 till today. And to me, they're all the reasons why you shouldn't be invested, or at least people get scared. And for instance, Lehman Brothers filed for bankruptcy. That was back in 2008. The end of the EU and the IMF bailout, Ireland. Just reading through here, Chinese stock market crashes. That was in 2015. U.S. Fed fund rates starting to hike by 1.25%, 75 basis points, etc. Trump hikes the Chinese tariffs from 10 to 25%. COVID, Omicron, Hamas attacks Israel. I'll give you so many reasons why you could be afraid of what's going to happen to stocks. And all of them turned out to be a blip. That's it. And when you look at a longer term chart, you realize that If you get out at these points, you're hurting yourselves. Talk about we have clients who do get scared, and it's hard sometimes to keep that fight or flight mentality out of people's emotions. It's very difficult because that's who we are. We see the saber-toothed tiger, we want to run. All right, well, that hasn't changed. We've got something in our head called the amygdala, and that amygdala controls that fight or flight emotion. So we have to make sure that we're not just making emotional decisions. Vince, you talked about the election. I don't think in the long run, it hasn't mattered in the past.
It hasn't.
If it's been Republican or Democrat. I'm not saying that there aren't policies that I necessarily favor one over the other, but as far as the stock market is concerned, it hasn't made one bit of difference, really.
No, that's true. It adjusts after a new administration comes in, and it will move accordingly. And again, it's driven by earnings and revenue growth in companies.
Exactly.
And as long as you're buying good, high quality companies, no matter who's in the White House or whoever is in controlling Congress, stocks are going to do well.
Right. And if you're really, really nervous about being in the stock market, let me put it a different way. If you're nervous every time the stock market goes down, the chances are you should have a smaller portion of your portfolio in stocks, because the idea here is to have some growth in the portfolio, especially when you take taxes and inflation into consideration. If all you're doing is buying CDs and treasuries, you are not going to get ahead of the game.
Eventually, it's going to catch up to you. You're not going to keep up with inflation, and you
have to pay taxes eventually. Even if it's in a IRA, eventually you're going to pay tax on that.
What's interesting, as we're kind of reflecting back, I was looking at some First Trust kind of resources as well, and one was Staying the Course. And through, from 1980 to now, there's years that intra-year that the markets are actually down, but we've actually ended up positive for the year. And there's times the markets can move 5, 10, 15, 20, even 30% or more within the year. And so once again, if you're not in the good allocation, or if you're not going to stay the course with your investments, then like Steve mentioned, maybe, we have to revisit your allocation.
Well, I just was talking to a client recently who the last time the market went down, which was back in 23, I believe was, when we hit bottom in October, they wanted to get out of everything. We convinced them not to do that, but we did get out of some because they said they have to do something, which I'm not sure why people think that. But they took that money and put it in a CD at 5%. Well, that sounded pretty good when the markets were down. But from that point that they got out, the markets went down about another 5%, and then from that bottom went up 90%. Okay, so they got 5%, and they probably left on the table about 80%. So you just don't want to do that.
So here we are, historically from 1926 through now, the positive, negative years in the S&P 500, which is just one index. But there were 72 years that it was positive and 26 negative years. So once again, we're not going to always have the positive returns, although we all want it. But the reality is there are going to be times when the markets are down.
Yeah, but you can't give up. It's like, picking your tulips, before they start getting out of the ground. Yeah. Let the market do its thing. It has always in the past gone up. Not a guarantee that it will be in the future. But, there's no reason to think what'll happen is no matter who gets in the White House, okay, because this is apparently one of the big things that I'm hearing today is that they're worried about the election. They're worried about Israel. They're worried about Iran and all that. But mostly it's the White House. It doesn't matter who is going to get in as far as long-term approach. The only thing that matters is earnings for companies. Are the earnings good? Are they growing? Because I tell you what, I don't think, unless we become totally socialist or something, I don't think that the government is going to dictate how much Coca-Cola is going to be sold or how many houses are going to be bought. Or they certainly can affect that to a certain degree, but only to a small degree.
Yeah. That's why I say don't play politics with your portfolio. Right. Stay in good names.
And it's really funny, too, because depending on who's in office, which side is in office, the people who are the most, rabid supporters of the other side are the ones that get scared the most. So when the Democrats are in office, it's the Republicans who are very, very, very rabid about that who get really concerned. And when the Republicans are in office, it's the Democrats on that side who are rabid, who get concerned. You got to get away from that when it comes to your portfolio. Politics is one thing, economics is another.
And so kind of wrapping up, once again, if you have any life adjustments or anything happening personally, that's when it's a good time to revisit and make sure you're staying in touch with us and letting us know.
And again, make sure your asset allocation is appropriate.
Yeah.
You can stay out of a lot of emotions if you say, okay, and just making up figures here, maybe 60% of your portfolio is in stocks and 40% in something else, and maybe some of those stocks are paying you dividends, which continue to get paid, in most cases, and a lot of cases it goes up, and so you can say, okay, well, wait a minute, first of all, my whole portfolio isn't being affected by it, especially if you're older, you don't want to have those down times, but you just say, okay, I'm gonna do my little meditation, do one of those things and just relax.
Yeah, so it ties into, are your investments based on your financial and retirement plans, and making sure we revisit that.
Yes, in the words of Aaron Rodgers, relax.
Is that what he says?
He did when Green Bay started off with. By the way, Aaron Rodgers, used to be quarterback Green Bay. When they started off badly, he just told the fans, says, just relax. And sure enough, by the end of the year, they did fine. So anyway, that's a wrap for this week. I guess you kind of get the idea that we don't want you to make rash decisions. And we'll see you again next week. Thanks a lot. Bye.
Thank you.
Adios.
Please stay tuned for important regulatory disclosures. WWM Financial is an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry and how we may be able to assist. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. As always, please remember, investing involves risk and possible loss of principal capital. Tax considerations presented may not be appropriate for every individual circumstance. A tax professional should be consulted before making any decisions about your tax liability.